Pleasure to be here today. I've pulled together several dozen slides, and really what we wanted to do is share with you some of our thoughts and experiences that we've had both through our careers and with clients as to what impacts value for middle market companies. So I thought I would take you through this. If you've got questions, I know in some of this there are probably some of you that are a lot sharper than we are, and would love to have questions, or I hope this isn't just a monologue through the whole thing. Really, we've got three big topics that I thought we'd share with you this morning. First off is the idea that what we see in the marketplace today is a gap. We call it a valuation gap, and I want to talk to you about that a little bit. The second is share with you some of the, just kind of a framework for looking at companies to begin to drill down on how do you think about improving the value of companies, and then kind of going into what are some of those levers, some of the things we talk about in the little book, what are some of those value drivers and levers that maybe either as business owners or advisors to business or lenders or investors, things that may help those companies. So that's kind of the outline for this morning. I've been active both as an owner-operator and grown and sold a couple of businesses. The last one was a technology company we sold to Raytheon, and then spent the last 15 years or so really as an advisor through High Rock Partners, working with middle market business owners. We talked about a couple of books, and the other thing that's kind of influenced what you're going to hear today is the work that we've done both in writing but also teaching. We have a middle market mergers and acquisitions certification program up at DePaul through the Alliance of M&A Advisors, and I'm part of the team that leads that. So that's definitely influenced a lot of what I see and how I think about companies. So I'd like to jump in and talk to you a little bit about this idea that there's a value gap. So let's frame it. When we think about the middle market, on the left-hand side of this screen, we probably all know this, but there's millions of small companies that tend to be below $1 million in revenue. As you transition up, obviously you have several thousand large publicly traded companies, and in the middle is where the large volume, and it's really interesting that probably half our GDP comes out of the middle market businesses. And so when I'm talking about middle market or lower middle market companies, I'm really thinking about 5 to 150 million in revenue size companies, and the unique kind of characteristics or circumstances around that segment of the market today. Even though some of these things apply to both ends, I'm really focused on that lower middle market. We many times get brought into a discussion when there's something, when there's a big strategic question on the table. Should I sell my business? On the same breath, hey, maybe I should actually raise some money and buy a competitor, or I may just want to raise some money and do some organic expansion. And there's always this, we get brought in, and there's a number of things that kind of instigate that conversation. But when we're trying to help owners think about a decision, the way we look at the world is kind of synthesizing 4 key sets of factors. The first one has to do with the owner's ambitions. And that's kind of a theme that we've had. Owners drive, and you'll see my next slide, owners drive a lot of the value in a business, depending on what they want to accomplish with that company. The second is, where's the industry that they're operating in? Where's the cycle within the industry? The third one is the general business cycle. Is there an expansion, or are we in a recession? That clearly affects how you maybe think about decisions. And then lastly, we're looking at kind of the strengths and vulnerabilities of the specific company and synthesize that. So, for example, there are certain clients that we're going through a decision process with, and they're thinking about trying to maybe hold on, and I use that term, they're at an age where they may want to work 5 more years, 8 more years, and they're thinking about weathering the next business cycle. Well, part of the challenge is, do you have the capability to weather that next business cycle? Do you have the stomach for it? And because it plays in, they may not have the value they want if they sell today, but they may not also have the appetite for continuing to run the business for a period of time. So this influences our thinking, as well as kind of 3 core concepts. And just mentioned the fact that we really believe fundamentally, it's our experience that the owner's motives really do drive a lot of the realizable value out of a transaction. The second is, and I'm probably preaching to the choir here with the group, but valuation is eventually based on future cash flow. And then lastly, which I think is really kind of helpful in the sense that you don't have to know exactly what your end possible transaction is, because the things we're going to talk about are independent of that, or they support any of whether you want to raise money, you're just trying to be a better performing company, or you're thinking about selling. And so we found a lot of things I'm going to share with you really support whatever direction or most common directions within a business. The other thing is to point out from a valuation perspective, I know many of you, we probably have some valuation experts in here, but from the way we look at things, a single company can have many values, and it just depends on what's the question you're asking. And so what we try to think about when we're talking about value levers is we're talking about the market type transactions, if you'll call them transaction values for lack of a better word. We're not talking about, and we're not spending time on fair market value or valuations from a tax or an estate perspective and those type of things. That's really not our domain. But so it's so critical to set that expectation that these are realizable values that are important to generally when we're having these conversations with our clients. One of the questions that comes up is, and I'm not sure what your experience is. I know we have a broad range of backgrounds in the room, but I go back pre-2008 and I think about the companies we did business with, and many times you would have companies that really weren't very good performing businesses, but we could get a deal done. There was it may be a higher cost of capital. It may be a lower valuation, but we could probably get a deal done. And I think one of the things that's changed is while there's a tremendous amount of capital chasing companies, I think the bar is still relatively high. The expectation is that you're going to be a better performing company. So I think that's part of what's driving this valuation gap that we see in the market. It's not everything, but that's part of it. And so we've asked, I don't know how many are familiar with, I'm involved with Vistage and EO and YPO and a number of different CEO organizations, and we've constantly asked the question, well, what does it mean to be a higher performing company? And so if we've compiled, and just this is a short list of what those CEOs over 3 or 4 years have said they believe are higher performing businesses. So this is kind of the CEO's voice of what they're thinking. And if you look at it, it all kind of makes sense. I mean, it's a little bit of motherhood and apple pie, right? But it is the ability to attract great people and talent and good customers. But you have to put meat on this. And one of the things many company owners don't think about, which we're going to touch on, is some of the financial metrics in terms that an outsider would look at versus how they may measure their financial performance. So I'm going to touch on that in just a little bit. And to lastly just point out why that there, and validate that there is a value gap is I've got a couple of slides that just have data from different surveys. So, I mean, for example, this was one from a Market Pulse survey several years ago that talked about why deals fail. And as you can see, unrealistic expectations is our number one driver. Another chart, this is from last year's Pepperdine survey that talks about why deals don't get done, why do engagements fail or don't close. And the number one is valuation gap in pricing. And then lastly, from the same survey, just picking up off of what's the size of that gap, it's really between 20 and 50%. Now, for those that do deals, you guys know there's always a valuation gap, right? I mean, there's never, the owners always think their business is worth more than either a buyer or an investor does. I'd say that's not always, but most of the time. But that gap is bigger now. And so that was somewhat compelling Buddy and I to say, let's take a little time and write down and try to share a little more of what can you do to try to bridge that gap. There are deal structural things you can do to bridge a gap, but these are more inherent in the business, and that's what we want to talk about. Our framework, it's a very simple framework we've used for years, and to look at companies is based on really trying to get alignment around 5 key areas in a business. And getting that alignment, I thought what I would do is kind of just take you through one slide each, just to give you a little bit of flavor of how we think about this. But we lead with strategy, we lead with the strategic health of a company, and then we end up with how do you finance it. So I thought I'd take you through that real quick. When we talk about strategic health, we're really trying to understand the market position. We're not talking about operating strategy or operating efficiencies. We're talking about competitive strategy, market position relative to an industry or segment. And some of the things we try to drill down on in a business is to understand, how do you really make money? I know that may sound like a crazy question, but the more we look at businesses, there are different product lines or service lines that really are the key earnings drivers. And understanding really competitively, what do they have that differentiates that would allow that business to keep creating cash flow? So we're looking at, I use the term secret sauce within a company. When I sold JPS, when we were positioning JPS to sell, one of the things that became clear to me is our secret sauce was, by the way, JPS made black boxes. We sold to 3-letter agencies to help connect communications from different types of communication systems. And our real differentiator against some very large players were these algorithms. You may have heard that word recently, but software algorithms that we had developed and that had a lot of experience embedded in them. And so had a lot of operating data over years and years of experience that you couldn't get in a laboratory. So what we did is we shifted. That really drove our growth strategy in positioning the business before we sold it and where we made our investments. And I find that many companies need to take a hard look at where they really can differentiate and where they invest. So I'll kind of drill down on that in just a minute. But having a clearly articulated growth strategy is a foundation for being able to sell a company, whether it's to an investor or a lender. Unless you're in a crisis, we start with that. The second is, and probably obvious, but you've got to have the right management team to support that strategy. The thing we see with many companies is that they're thinking about their team in the context of history, not in the context of where they're going. And so the harsh reality is, in my first business where Eric and I met, is our business had outgrown our team, including me. And I was struggling to keep up, and I didn't have the right management team in place. And it took a long time. We took some big missteps to get our team in place that could grow to the next level. And so an outside, whether you're an investor or a buyer or a lender, they see that, they look for that. I mean, many of you are in those positions today. And so having the stronger that team and the better aligned that team can be, in itself, it allows to de-risk the business or improve the value. And we do all kinds of crazy things to try to figure out what that right team is, like creating matrices and trying to rate people relative to their strength and their capabilities and experiences and things like that. And then thirdly, what we found is that the dependence on the owner-founder is a real detractor from a value perspective in a transaction. I know in my case, one of the things I learned, and I was in my 20s, is that I was in the classic command and control, and I had a lot of decisions reporting up to me, and you know that only goes so far. You can only go so far with a business doing that. And so finding ways to recognize the dependence on the owner-founder and really make a transition to where it's run by a management team is a critical aspect. It's so hard. I can't tell you the number of times in a transaction where we're trying to sell a business and you really determine that there's just a key component of that business or relationships that are tied to the owner. And it makes it very difficult to argue for future value when that owner actually wants to leave. So as you can imagine, that's a tough, a little bit of a quandary.